Welcome back to another Millennial in-depth video. Thank you for joining me. Today is Tuesday. It is Stock Tip Tuesday, in fact, and I know I skipped last week because I wanted to diversify the videos on this channel, and now we're going to be talking how to diversify our portfolios. And how do we do that? Then we need to understand the difference between mutual funds and index funds. Before we jump into this video, I'm going to start it off the same way I start every single video. If you are not subscribed, make sure you hit the subscribe button below, turn on the notifications so you get every single time I upload a video. And you always want to speak to a financial advisor before you start working around in the stock market world or before you make any major financial decisions with your money. Now that all of that fun stuff is out of the way, let's dive into the information. Mutual funds and index funds are different in three major ways. Other ways, they are similar, but we're going to focus on the differences in order for you to decide what you want to get involved in, or maybe you want to get involved in both. Who knows, right? So the three main differences between index funds and mutual funds are cost, management, and objective. So we're going to start off with management because that might be the easiest way to lead into the other two options. Management. Now, index funds are managed passively. What that means is you do not have to have someone who is actively watching the stocks, trading, buying, selling, all of these different things. You kind of set it and forget it. Right? Now for a mutual fund, it is actively managed. That means it is day trading or trading hourly sometimes in order for you to get the best return on investment. Both of them can make you money depending on the way the market sways. The reason why I like index funds more is because if you look, and I'll do some math even though I hate math. If you look on a 30-year frame, right, and you're investing $1,000 for 30 years on a 7% interest, you are going to gain more money. You'll get 99,000. I teach English. $99,000. As opposed to if you invest the same way with a mutual fund, you'll get back $82,000 because of the cost. So we're going into our second major difference. It usually costs about 0.05% to 0.08% in fees when you are investing through index funds, as opposed to mutual funds, which can be 0.82% all the way up to 3%. So you are losing more money in fees when you're ready to take that money out or to have that money work for you in a different manner. You're going to lose more money, or you're going to, lose. You're going to lose more money if you are investing in mutual fund over the same amount of time and the same amount of investment, right? So index funds cost a lot less, and the reason is because you don't have to actively manage. So you don't have to have someone actively managing your portfolio. Both of them are going to have a diverse portfolio. When you look into index stocks, you're going to be, well, let me back up. The reason that it's beneficial on both of them is you're taking out the risk in buying individual stocks. So for example, in index funds, you'll be investing in things like CVS, you'll be investing in things like Facebook, but you won't actually have to go out and purchase individual stocks in Facebook or individual stocks in CVS. And that's what I really, really stress about. Anything in the stock market, you want to have diverse interests. You want to have a diverse portfolio. And index funds and mutual funds tend to help people do that whenever they're getting into the stock market trading world. Now, the dangers with an index fund in the kind of volatile stock market world that we're in right now is if the S&P 500 dips 15%, then your index fund is going to dip 15% because it follows. Like I said, it's a passive form of investment. It follows the trend of the market. As opposed to a mutual fund, because they are actively trading, they're trying to get the highest return in all types of stocks going on. So they might buy this today and they might sell it tomorrow just to prevent you from losing money, right? The index fund, though, is still the safer bet when it comes to making the most money, because mutual funds sometimes can go awry depending on the state of the market or depending who's day trading for your hourly trading, depending on it really depends on what's going on. And it's a lot going on right now in the stock world. And the last major difference, because I do want to keep this video nice and short and sweet and clear and concise, although that was a lot of words to explain the same thing, the investment objective. I love objectives. Now, the mutual fund objective is to outperform the market. That is how they get the return. That is how you make a lot of money because you're actively trading, right? You're trying to outperform the market. Whereas an index fund is really trying to ride the wave of the market, if that makes sense in the most simple, basic terms, right? So like I mentioned, stock market goes up, index fund goes up. So the objective of the index fund is not to outperform the market like the mutual fund is. It's to, like I said, ride the wave, or to match, that's a better term, to match the benchmark, match the index before the fees. So you want the stock market to do well in order for your index fund to do well, but if your index fund takes a dip, it's not going to be as bad as if your mutual fund takes a dip, because those fees, that cost, when you go to take the money, you'll see you'll have a bigger loss or bigger impact of loss for a mutual fund. You always want to look into what works best for your money. Okay, so like I said, cost, management, and the objective are the main differences. So if the objectives and cost and management of a mutual fund suits your financial needs better, that is something you want to look into. If it is more aligned to an index fund, that is something you might want to look into. And that is all for Stock Tip Tuesday. Bye.